cash secured put options problem is what we will be talking about in this video. Ladies and gentlemen, my fine friends, there is a problem with selling cash secured put options. And in this video, we are going to discuss that problem and how your good buddy Brent handles it personally. How you decide to handle it, or even if you don't even want to go near that problem, totally up to you, totally respectable, whatever decision you decide to make in life. So I am just going to tell you how things that I do when I experience this problem and show you how I definitely do experience this problem. Now at the 1 minute mark of this video, there will be a link to a video that's going to be popping up right here. And this other video discusses the unfair advantages. There it is. Get ready for it. Boom! 1 minute mark. The unfair advantages of selling cash secured put options on stocks you would be happy to own. This is the key word here. And this is also pardon me, that's not a word, that's a phrase. This is the key phrase here. And this is also the key phrase to dealing with this problem. At least the way that your good buddy Brent deals with it. Now, we're coming up on the 1 minute and 30 second mark. I'm going to put another link. Boom! There it is. 1 minute. There's a link at the 1 minute mark, and there's a link at the 1 minute and 30 second mark. The link at the 1 minute and 30 second mark is to this playlist. If you're relatively new or completely new, this is a good playlist to go through. It's not the be-all, end-all. Your good buddy Brent at ihavesuccess.com. I'm not here to be the be-all, end-all. I'm just here to help a little bit. You take it for what it's worth to you, and then you move on with your life. If you like what I do, I got paid stuff. I got free stuff. If you don't like what I do, you can just take my stuff and stuff it somewhere. It doesn't matter to me. I'm just going to put the content out there. The people that like me, they'll get some value out of it. And the people that don't, and trust me, lots of people don't like me. I just deal with it. And they'll do whatever they do. But I'm doing this because in 2023, and this was true in 2022, and we can keep going back in time, and it's going to be true going forward in time. I believe if you have an internet connection, you got one bank account, brah, you spend money at least once a year, then you have no legitimate reason not to be selling cash secured put options. Get ready for this catchphrase, on stocks you would be happy to own. All right, so you handle the free stuff, the paid stuff, no stuff, whatever. I got to handle this stuff real quick. This is not financial advice. These strategies may not be suitable to you, and the ticker symbols that I discuss, they might not be suitable to you either. I'm not your financial advisor. I'm only my financial advisor. But what I will recommend, in the world that we live in, I would recommend that you at least consider learning how to make suitable decisions for yourself so that you do not need to trust the suspect opinion of others for your well-being. If you want to trust other people for your well-being and that fits your personality, you go for it. But this is for my brothers, my sisters, all my different pronoun peoples that want to be mentally independent from others. All right, so not financial advice. I'm suggesting, only advice I have for you is to learn how to think for yourself and make financial decisions for yourself. I'll try to give you some content here at this YouTube channel and at this website to help you do that. But again, not financial advice. So how do you learn how to make good decisions in the market? You paper trade. Do not fall victim to the pretender willies that tell you that paper trading is a waste of time. Don't do that. If they would not, let's say, if the same pretender willies pretending that that paper trading is a waste of time, if they really believed that, then they would not do simulated training for anything. For example, if they were going to be in the fire department, they would never do simulated training. If they were in the military, they would refuse to do simulated training. If they were going to be an MMA fighter, they would refuse to punch a bag. They would refuse to do any type of drills other than getting in real fights with real people. I don't know anyone that really is like that. So the people telling you that paper trading is a waste of time. They're pretend-a-willies. Just let their pretend-a-willy BS go in one ear, let it go out the other, and move on with your life. Now that is my advice to you. Let's get into this, my friends. Let's just get into it. I'm going to give you three scenarios. I'm going to give you talk about the problem first, and I'll give you three different scenarios that I have encountered. One of them I'm currently dealing with. Well, I guess two of them I'm currently dealing with, and we'll just have real talk. Everyone claims that they want real talk. I'll just give it to you, and the people that just claim it and don't want it, you can turn the video off, and a few of you will stick around because you'll be like, you know what, good brother Brent, he's just telling it like it is. That's right. I'm just going to tell it like it is from my perspective. And so the problem with selling cash secured put options, the number one problem, the biggest bummer with this is, let's say you forget about this is SPY and forget about the numbers. Let's just look at the chart, right? So let's say whatever stock this is, whatever price it is, just looking at the pattern. All right, let's say you around this time you see this somewhere in here, you see the stock okay, right through here, right? You're looking at this, you say, hey, look at this, right around here, you see it kind of clumped up around here, and then it rallied up here, you see it pivoted here, it's going up here. Now you see it getting in this clumpy area, right? It's getting pretty volatile. And then you see right in here, you're like, bam, oh, look at that, looking to the left, just like Dan and Greg tell me to do over at Master Trader. I'm looking to the left. Oh my gosh, look at this, look at that. Got down here to the support, boom, it's back up. So what do? You sell yourself a cash secured put option right here. Boom, you sell it. That's your strike price, not when the stock is kind of up here though, or maybe it's down here. I don't know. Sometime before this, but here you get assigned. You sell it here, and oh my gosh, the stock, you get assigned, and then look at this, the stock drops down here, and oh golly gee willikers, you know, I'm assigned here, and now I bought the stock for whatever $420, and now it's down here at 360. Oh my gosh, woo! That is the problem. Now I'm being theatrical. I'm attempting to be theatrical. I don't think anyone's going to find it funny, but I'm doing it anyways. So that's the problem. The problem is that you take assignment of a stock, and then the stock keeps trading lower than the price that you took assignment at. And this is a real thing. It's not a pretend thing. If people tell you like, oh, don't worry about it, it's no problem, it's no big deal, you're over-exaggerating it. I don't think that's true. I don't think it's an over-exaggeration. I think it is something to not necessarily worry about. I mean, worry is a particular word, but to have a plan for. You can have a plan for something and not worry about it, right? When you're thoroughly planned and you understand how to handle the situation, then you don't have to worry, because worrying kind of is a gross, kind of sucky emotion to feel. So, you know, just when you take assignment of a stock and it's trading below the price that you took assignment, like that's a crappy enough feeling. You know, why add the worry? So so some of the things that your good buddy Brent is going to do to mitigate this is one of the first things that I'm doing is that I'm only doing this on stocks that I'm happy to own, right? If I'm not happy to own the stock, then I'm not going to do it. And when I say happy to own, you notice there's no asterisk. There's no like asterisk that in the bottom, you know, under the fine print, it says happy to own at a particular strike at a particular price. No, I'm talking about a stock that I'm happy to own, regardless of what price. Even if it's at a price lower than the price that I bought it at, I'm happy to own. Why would I be happy to own it? Because I'm suggesting that you're finding stocks that are going to be around longer than you're alive. Maybe it's a tall feat, you know, but hey, welcome to the world. I'm sorry, that's the way that I see it. And so that's what I'm doing and another thing that I'm doing is, look, I'm playing the game, right? I'm playing the game. If you're going to play the game, consider playing the game and realizing what the risks are. So this is one of the risks. So one way I'm trying to mitigate the risk is I'm looking for stocks that I feel are going to be around longer than I'm going to be alive. So that's That is one thing that I'm doing. And then there's ways that I do that. And these downloads and these this playlist, hopefully that'll help you. Again, it's not the be all end all, right? You might have to do some more research and learning, but at least it'll give you something to start with. And so from there, picking a stock that I'm comfortable owning. So if I didn't tell you, I got 3 examples, and the first example is a stock that I'm definitely happy to own it the rest of my life. I'm happy to own it because I believe, and this is a big speculation, but I believe this company is going to be worth more in 20 years from now than it is today. I'm very happy with the price that I bought it at, but unfortunately, the price that I bought it at, the stock is currently trading below the price that I bought it at. So I got 400 shares of this particular stock that I bought for a certain dollar amount, and it's about, I don't know, $1.50 below. Because it's a stock that I plan on owning forever, I don't pay a whole lot of attention to it. But I'll tell you why it's even a worse situation than just being like $1.50 below the price that I bought it at. The reason why it's a worse situation is that it's not a very expensive stock, so it's a significant percentage below the price that I bought it at. And to make matters even worse, it doesn't pay a dividend, right? So normally, this is the only stock that I own right now that does not pay a dividend. It is a big speculation for me, but I truly believe that in the next 20, 30 years, or even 10 years or something, it's just, and here's another thing, is the 400 shares, if the stock were to go completely to zero, it's not that I'm happy with that, but this losing that money is not going to change my lifestyle. It's like just a risk trade for me. A risk trade, a speculation that I entered, a risk investment that I entered via selling cash secured put options. And some of the shares I just bought flat out, and some of them I bought by selling the cash secured put option. Normally I sell cash secured put options on stocks that pay dividends. This one doesn't, and I still think it's worth the money that I put into it. And to make matters even worse, if that wasn't bad enough, right? That it's not the most expensive stock, so being down $1.50 is significant to this position, and it doesn't pay a dividend. And to make matters even worse, it has some real crappy option volume. It only has 3 strike prices for the option chain, and one of those strike prices is below the price that I bought the stock at. And to make matters even worse, there's hardly any liquidity. I've had an order open at a particular strike price that's over the price that I bought it at. I've had an order open for like 2 or 3 months now, and it has not been filled. It's not even close to getting filled. Now I have been filled on covered calls on this before. There was a while where I was pretty consistently selling 4 covered calls against this. So I was at least cash flowing it that way. But for whatever reason, the option premium has dried up on this particular stock. And your good buddy Brent is basically sucking wind on this one. But it's all good. Like I'm not bothered by it, to be honest with you. Even though, hey, it's a problem. It's definitely a problem. But I'm not worried about it. And the reason why I'm not worried about it, and I'm totally okay with it, is because, again, why did I buy this stock? I bought this stock because I'm planning on holding it the rest of my life. It's a relatively new company, and I think that sooner or later they'll probably start paying a dividend. And I also think that it's going to be, by the time I'm dead, it's going to be well over the price that I bought it at. It's probably going to be paying a dividend. I think the option premium and the option liquidity over time will become richer. And if I'm wrong, whatever, man. When I used to drink alcohol, I wasted more money on alcohol over the years that I was drinking than I'm wasting here. So that's the way that that's the perspective that I take on it. So that's scenario number 1, right? And I'm currently in that one right now. And there's another scenario where what happened, it took 1.5 years for this to play out. But there was another scenario where about 3 to 4 years ago, yeah, right around 3 to 4, maybe yeah, 3 to 4 years ago, somewhere in that COVID area, I took assignment of 2,200 shares of a stock that's it wasn't an expensive stock. And it was like, I took ownership of these shares at around like $5.50. I don't remember if all 2,200 shares were at $5.50, but overall, my original cost basis was right around $5.50. And then, and this is a stock that I had been trading since, like, I first remember trading this stock in 2014. So, and then this happened around 2019, 2020. Because I remember it was kind of in the beginning of sometime in COVID, in that area. So maybe it was like 2020. And but it's a stock, I had been trading the whole time since 2014. And so here it is around 2020. I'm selling these cash secured put options on it, and then I get assigned at $5.50. No problem, right? Because usually, like, I can get out at like $6 a lot of times, and for whatever reason, that didn't happen this time. This time, what happens, instead of going up to 6, and it goes down. It goes down because, like, the trading range that I saw that stock doing in the years that I was trading it was like around like 350 to about like 650 to 7. So I was a little bit on the riskier end of it, selling at $5.50, but I thought it would be okay. And so I loaded up. It was like a 10 grand position, and considerably more amount of money tied up into that than the 400 shares that I was talking about with the other one. And I was okay with that because this was a stock that I really had my finger on the pulse of the personality. And it did something that I was not expecting. It went the opposite direction. And I think it went all the way down to like 350 or something. But I was in this position for about a year and a half. And for the reason why I was in it so long is because for about a year and a half, it stayed below $5.50. But throughout that time, the stock at the time, I haven't been trading this stock, so I'm not sure. It got like merged with another company or something. So the option chain doesn't look the same. It does not have the same amount of strike prices. It does not have the same liquidity anymore. So I don't even trade it, because it's not the same thing that I had been trading all that time. It used to always have really good option premium, and it had a lot of option liquidity. And for being a low price stock, it had decent premium. So when I start selling 10 contracts, or at that time 22 contracts, it was like I'm getting paid a decent amount of money, even though it seems like per contract it's not a whole lot, but when you multiply it by 22, it's a pretty good amount of money. And so while it was below my strike price, I was really in tune with this particular stock. And COVID's going on, so I'm like staring at charts all day. And I was in the zone, my friends. So what did your good buddy Brent do? And I start selling covered calls below the price that I bought it at. So let's pretend this is $5.50. Boom! I'm selling covered call right here. It's $5.50. I'm selling the $4 covered call. Wow! It's going the opposite direction. I'm selling the whatever $4.50. I'm selling below the price that I bought it at. And for a year and a half, I sold. I don't know how many times I did this, because generally for me, the shorter time frame I'm selling, the easier time I have of predicting what's going to happen in the chart. So so I'm selling like maybe 2 weeks, a week, probably 2 weeks at the most. And all the time I'm doing that for a year and a half, I'm selling strike prices below $5.50. And I'm collecting dividends, and on 2,200 shares, and it pays a pretty good dividend. It was I'll say this, it wasn't that bad. It was not bad. It was not bad at all. I was was quite enjoyable, to be honest with you. It was totally okay for me. Now, the first scenario I talked about, that's not really enjoyable. I'm tolerating it. I don't care. But I tell you what, the other one, man, I was like, whoa, I was having a good time. I'm like, oh, I was like, dang, I'm collecting a grip of option premium here for 2 weeks. I'm like, oh crap, look how much money I just got. I was like, whoa, I'm glad I got 2,200 shares here. And then eventually what happened is it started going, higher again, and pretty soon, it's, I guess not pretty soon, after like a year and a half, I'm exiting that position at selling all those shares for $6. So I made whatever 50 cents per share, from 550 to 6. Yes, it took a year and a half to happen, but through that year and a half, I collected dividends, and as I mentioned, it was a pretty decent dividend for an inexpensive stock, and to have 2,200 shares, I collected a decent amount of dividends, and option premium was pretty good. I remember one time I had I think I got like $88 for a week. Hey, my car insurance is $87.50 for a month, so I covered my car insurance payment. 1 month of car insurance I covered in a week without leaving my apartment. It's not bad. It's not bad for me. I don't know if it's, I don't know what your bills are like and what your life is like. I don't know. But for me, it's all good. I was happy with that. So that's another example of dealing with this cash secured put option problem. It is a problem, right? We're not downplaying it. I'm not downplaying it. I don't know about we. I mean, maybe you're downplaying it. Listen to it. Maybe you're over exaggerating. Listen to it. I don't know. I'm just talking into a recording device here. But so I'm not downplaying it. It's a problem, right? Trading. There's problems with trading and investing, right? That's the way it is. And what I'm trying to do, and what I would suggest for you to do, is be aware of the problems before you go into the position, and have an idea of how you'd handle the problem if it comes up. All right, so that's an example of a problem of the stock being below the price that I paid for it at, and that was one that I'm not dealing with anymore. And the last one I'm going to talk about, it's another one that I'm currently dealing with, and it's a stock that I also have been trading the stock since around 2014. Although I tend to trade that other one. That was like my go-to one because it was so inexpensive that I just love to load up on shares. And when I it's not like I have it. I'm not dealing with a Ray Dalio trading account at the moment, but compared to where I'm at now, compared to where I was then, I was really starting on a shoestring budget, and so this other stock, I have been trading it on and off since around then, but that other one was my go-to. Like, I had that one down. I really had the personality of that one, and I would only add at other times, but at least in the beginning, because it was inexpensive stock, and I just didn't have a lot of money to put into the market back then. So this other one I noticed, I remember it being as low as $5, and I remember one time it traded as high as 24. So this other one that I currently have a position in, it had this big range, and this stock has a cult following. I think in these downloads, one of the downloads I talk about certain stocks, they'll have a cult following. So that is something to consider. It doesn't mean that you join the cult. It just means that you are able to know that there's a cult following this particular company. And, for example, even though Apple has a very good financial statement, they still have a cult following. Now, Tesla also has a cult following, and maybe it's more like Elon Musk. And I don't know if he has the same sort of cult following that he does nowadays, because it used to be when he was like this big cult leader for the green movement, but then somehow he kind of became this cult leader, or I don't even know if he's a cult leader, but now he's like not really talking about in the green movement. Now he's like, I don't know, somehow doing this Twitter thing, X or whatever. I really don't know, because I'm not in the Elon Musk cult. I'm not in the Tesla cult. I just know that there is a cult following, or there was at least at one time. There used to definitely be a cult following. So there are, and this stock that I'm talking about is neither one of those stocks, but it is a stock that has a cult following, and it has a very charismatic CEO. So the CEO will do a lot of interviews, and that's one way you can find yourself a stock that has a cult following, is that it might have a charismatic CEO that does a lot of interviews. And, you know, doing a lot of interviews in this day and age, you know, you put yourself out there and you could get some cult followers. And so this particular stock, it doesn't have the greatest balance sheet, but it's in an industry that I am 100% certain that this industry is going to be around as long as human beings are around. Without a doubt. If you want, you could try to poke holes in that. I probably won't really even listen to your hole poking because I've already made up my decision. It's not even like, I can't even really say I've made up my decision. I did say that, but that's not the most accurate way to say it. It's like, I'm 100% confident that this industry is going to be around as long as human beings are around. So I'm not worried about the industry going away. There's a cult following. The one thing I am worried about is the balance sheet of the company. The stock price, though, as I mentioned, I see that it really fluctuates. And this company has been around longer than I have been paying attention to this stuff. But I first started becoming aware of and kind of following this company probably 2011-ish, I'm guessing. But I really started trading it maybe 2014. Around 2014 is when I really got heavy into selling cash secured put options. And so maybe about less than a year ago, I can't remember when, but it's probably been about 6 months. 6 months ago, I sold 2 cash secured put options on this particular stock with a $9 strike price. And, you know, to me, it's got a trading range of about $5 to 24, but it kind of takes, it doesn't like do it really fast, but that's the trading range that I consider it. So for me, I thought it was okay. I buy it at $9. You know, if it goes back up to, if it's on its way to 24 and I get out at 10 or 11 or whatever, I don't care, you know, and if I buy it at 9 and it goes down to 5, I don't care, because I don't think the company is going away. I get it. It kind of ties up money, and that's not the greatest. It does pay a dividend, but it doesn't really have a great dividend. It's got like I don't know. I forgot exactly, but I think it's like, so it's less than a 2% dividend, but I don't really know where it falls. I can't remember where it falls on the range of 1, but it does not pay anything exciting on the dividend. But there have been times when this company, it has really, really good option premium. And so that's one reason why I basically use this company like the wheel strategy. It's a company that I will wheel strategy probably as long as I'm wheel strategy. It's one of my go-to stocks to do the wheel strategy. You know, it's not something that I would want to, like that first one that I was talking about, that I just, you know, I'm okay with owning it. It's that type of speculation. It's definitely a wheel strategy type of stock for me. But mainly because of the balance sheet. It just doesn't have the best like financial statement. And so I'm okay with wheel strategy in it, but I just don't want to like kind of buy and hold it, and you know, and it doesn't give the greatest dividend. You know, it's like less than 2% dividend, so I'm not putting it in that bucket of like a, you know, long-term hold. It's just more like try to cash flow it. So anyways, you know, I'm okay with it buying it at 9. So I get it at 9, and then I don't remember how long afterwards, but the stock it went below 9. It's been below 9 for a while now. Like I think I've had it for about 6 months, and I can't, and let's just pretend, even if it hasn't been 6 months, let's say for most of the time it's been below 9. And so what I have been doing with that one is that I have what I have been doing is I bought it at 9, and normally I like to my ideal way of selling covered calls is I like to be around like I don't know, I'm really into like these 11 days. You know, I kind of like 2 weeks or less because the time decay really kicks in fast. But you know, if I got to, I'll go out to like 20 days. I think the Tasty Trade people, you know, think like around 20-day mark is a good time to do it. But you know, if I, you know, I'll even go out to the 30 days, and you know what the heck, on some of them, depending on what the situation is, I might go out to 40 days, 50 days, 70 days, you know, depending on what the situation is. But what happens is, like, let's take a quick look here at the 10 days. We'll go 11. At the 11 days, look on the call side. Now you see we got lots of premium here, and right here it goes below. Right here at the 455 strike, it's going below $1. And then down over here, we're down into the single digits, right? At 463. I mean, excuse me, 464. Now when does it go? When does it go to right here? Now this is the last strike price where there's any sign that you could actually sell this option. 476. At the 476, and then 477.0 right here, right on the bid. Now let's do this. Let's go out and look at 70 days. Let's drop down here to the 477. 476. Look at that. We're at $1. A little bit over $1. 478, a little bit under $1. In order to get down there to the single digits, we're all the way out to, looks like in the 500s. And then right here, 555, we're hitting 0. So my point of bringing this up is that as you go out in time, you can get paid premium for strike prices further away from where the stock is trading. So with this particular stock that I bought at $9, I was going out further in time, and I was selling the $10 strike price. And I was doing that for most of these months that I've had the stock. So I had 200 shares. I'm selling two $10 covered calls, and I'm just going out in time. I don't really care. It's not a big deal. I'm just riding it out. And if you were to say, well, what if the stock skyrocketed up? I don't care. I don't care. I'll get called away, make whatever, you know, make $200 plus the option premium that I got, and then I just start selling cash secured options again. Like, I don't care. I'm just wheel strategy in this. And then, but I decided for some reason I was like, you know what? Let me look at selling. I looked at the chart and I was like, let me look at selling below $10. And so what I end up doing is I think of a days to expiration was about like maybe 30 days or so. I can't quite remember exactly, but it wasn't like 10 days. It wasn't like 15 days. It was a bit longer. It's probably around 30-ish days to expiration. And I sold a $7 strike. 2 calls, $7 strike. So they're cash secured, but the problem, right? Again, it is a problem. We're not downplaying it. Cash secured put options problem. The problem is I'm selling a legal commitment to get rid of the stock $2 lower than I bought it. Not good, right? If I had to do that, I would lose money. So with this, the reason why now this one I hadn't been Hawkeyeing, right? I think that second example I told you, like, I was watching that stock all the time. I really was in tune with that stock because this is like my daily trade stock for several years. It was like my go-to stock all the time. I was always trading that stock, that first one, the $5.50 one, that ranged from about like $3.50 to $7. And so this one, I haven't really been watching it as much, so I didn't really know the personality. I just kind of looked at the chart, and this is kind of what I saw. So let's back up this here. Let's pretend that let's pretend that this 420 is the $7 strike, right? So I bought it up here at the $9, and it's down here, and I see, oh, okay, oh, it went up to 7. Okay, it pivoted here, went back down to whatever price this is, got up here, and let's say if this is the this is our $7. Let's say this is $6. Okay, now it comes up here 6. Turned around. Okay, not even getting too close. Got up to 650 and turned around. Boom. Up here, got up to 7 again. Turned around. Look at it. It's not. And now let's say right here, I decide I'm going to sell the $7 strike because I don't think it's going to go over 7. And I got something else to tell you. The other reason why I decided to sell that $7 strike is because I told you I had 200 shares, right? And this being a stock that I like to do the wheel strategy with, right? It's not a stock I want to load up with 2,000 shares, but, you know, 100, 200, 300, 400, 500. I'm okay with that. I'm definitely okay with 100 to 500 shares. So I was at 200, and I happened to check out my little piggy bank, and I thought to myself, if I had to buy 200 more shares somewhere under $7, like if I bought 200 shares at $7, I'm looking at $1,400. Do I have about $1,400 laying around that I could cover these 2 call contracts? So I wouldn't be, if I had to get called away, I would. So basically what I was planning on doing is that I had a little bit of extra money laying around, and let's say here's a $6 strike. I thought to myself, if this stock goes above $6 and it starts trading around $6.50, then I got to make a decision. And that decision is, how quickly am I going to buy 200 shares below $7? So that way, if it goes over 7, I'm not getting rid of the shares that I bought at 9. Then I'm getting rid of the shares that I bought at below 7. And that is exactly what happened. What happened, at least that's what's in the process of playing out. What happened was it went over $6. Start trading around $6.50. I covered around $6.70. And so then I went from I had 200 shares that I bought at 9, and now I have 200 shares that I bought at $6.70. So we got $9 plus $6.70 divided by 2 in this case. Right? Now I'm looking at an average cost basis of 400 shares. Right? Okay, if I'm doing the math wrong, look, I'm not a math whiz. That's why I'm using a flipping computer or calculator here. But roughly speaking, you see how it goes, right? I brought down my cost basis to about 780, 785 or something like that. So then I'm in a position where I called my broker and I said, hey, if this particular stock is over $7 upon expiration and I'm getting it called away, I want these 200 shares that I just bought for $6.70. I want them called away. I want last in, first out. I don't want first in, first out. I want last in, first out. And there's about a week left on that contract. And at the moment, the stock is now trading around $6 again. So about $1 away from my strike price. And I think I think the probability of that stock remaining below $7 is pretty high. Am I in a bad situation? No, I'm not in a bad situation. Because even though this stock doesn't pay a great dividend, I just doubled it. It's a stock that I've been trading since about 2014-ish. I knew of since about 2011. Started really trading it around 2014. Off and on trading it since 2014. So it's a stock that I like. Now my cost basis, instead of being 9, is at about $7.85. Doubled the amount of dividends I'm getting from it. And now what I can do is, instead of selling 2 covered calls, I can sell 4 covered calls. And that is exactly what I did. So I went and I sold 2 more covered calls, but I went further out in time. I went further out in time, and I sold them at the $10 strike price. And right now, so I have 4 covered calls on the stock since I have 400 shares. 2 of which I already had. It was those compromised the compromise calls at $7, which now are covered at $6.70. And my original 200 shares, boom, I got another 200 or two covered calls against them at $10. So I'm good. I like it. Now, is it the ideal situation? No, it's not ideal. But what I've found after 46 years of being alive is that there's a lot of things in life, they're just not ideal. And I'm just trying to make the best with what I have. I'm trying to make the most ideal situation out of an unideal situation. An unideal situation. So there are problems to selling cash secured put options on stocks you'd be happy to own. There are definitely problems. And having an idea of what those problems are and how to deal with them can give you more choices. Because look, we're talking about options, right? So the more understanding you have of the problems and how to manage the problems, the more choices, the more options you will have. And for me, I love it, man. I love it. Now, this is not the only strategy that I do. Overall, though, I'm a net option seller. Right now, I've got a fantastic short strangle on WTI crude oil futures. Look, that is not cash secured at all. It is a completely naked position, and I'm 100% happy with it. So I sell naked options. I sell covered secured options. Sometimes I take long positions. Not nearly as much, though. I take, not long positions, pardon me, directional trades. Sometimes I'll do directional trades, whether I go long a credit spread, or whether I just go long a stock, or whether I just go long an option. I guess I wouldn't be going long a credit spread. It'd be going long a debit spread. I'm such a net option seller that my whole vocabulary is just kind of geared around there. So if I never did a directional trade again in my life, I would probably be okay with it. I'm just pretty much net seller, but I'll still do it, right? If it looks like it's a good setup to me, and I have with what's going on with my life, I've got the situation in my life at that moment to manage that position, I'm okay with it. But this is my bread and butter. This is my bread and butter. This is what I'm gonna do. I'm gonna do this. The last thing that I do, because what will happen for all of us probably is that we'll probably get old. I mean, some of us are going to die before we're old, but a lot of us, we're going to die when we're old. And as we're getting older, our cognitive abilities start decreasing. So we're just not as smart as we used to be. Memory isn't as good. Awareness isn't there. And then, and this is probably the second to last strategy that will go. The last strategy for me that will go is just long dividend producing stocks. Because, I don't know, maybe I'll be at some age and all these stocks that I collected over the years that I'm keeping for dividends, maybe I'll just sell them and have one final party before I kick the bucket. Or maybe I won't. I don't know. But that's my plan, is that as my cognitive abilities decrease, like when I start slipping on the mind, I'm not going to be selling naked options anymore. Maybe I'll just stick to cash secured options. And at some point, I won't even be doing that anymore, because I'll be an old fogey and I'll just be doing whatever I do in my old age. So I love it, man. I these problems, the cash secured put option problem, it's not enough to steer me away. I love it. Like I gave you 3 different examples of problems that I had, that I'm either 2 of them are currently dealing with, and 1 of them I already dealt with. And each one was kind of unique in their situation. But look, there's problems to them. If you do directional trades, there's problems. If you don't trade, there's problems. If you put your money under your mattress, there's problems. If you put it in the bank, there's problems. If you invest in real estate, there's problems. If you buy some wacky course off YouTube to have someone build you an Amazon course for free, there's still going to be problems with that. Whatever you do, there's always going to be problems. You set up a lemonade stand, there's problems. You don't have a job, there's problems. You make too much money, there's problems. So instead of, so the advice that I will give you, the financial advice that I will give you in this video is learn what the problems are, figure out how to manage them before you get into them. So that way you just handle the problem as they come up and you don't have to worry about stuff. If that is suitable for you. Hope you guys have a fantastic day. Aloha.